Good morning, traders and investors. My name is Roger Scott, and today is Thursday. It's August 26th. The market's not going to be opening up for another 2 hours, but I'm an early bird, and I want to get you guys the data before the market opens or right around the time market opens so that you can make the right decisions throughout the day. Now, markets are going to open up a little down, nothing really to write home about. As you can see here, this is randomness. S&P down 3, Dow's up 17, the Nasdaq's down 23, which is not really a lot if you consider the values at 15,000. So not a lot before the opening bell, and I'll tell you why. The reason is because today we have GDP. That is the biggest report of the quarter, and that's going to tell us whether or not economy is humming along. The expectation is 6.6%, and personal consumption is 11.8%. If the number is weaker, if it's to the downside, the bond market, which dropped, who told you the bond market was going to go down? Remember, three tops coming down? It's coming down. If the number is weak, then the bond market, if the number is, let's say, 5.5, for example, then the bond market will probably rise. If the number is 6.6, 6.5, 6.7, 6.8, 6.9, that means the bonds will fall. Because if the number is really strong, that means the economy is expanding. And if the economy is expanding, then the Fed is more likely to take action in slowing down the bond purchases, which would cause bonds to go lower and interest rates to go higher because they're flipped. If, on the other hand, the report is weak, say 5.5, well, then the Fed can say, well, the economy is not running hot enough, and we're going to keep our gas to the, we're going to press down on the gas pedal. So again, keep your eye on the bond market and on the GDP because that's going to be very instrumental. And the target is 6.6% on an annual rate, and personal consumption on an annual rate, 11.8%. That's going to happen today. Another report that's coming out is the jobless claims. I'm not expecting too much from the jobless claims. The number has been below 400,000 now. The average is 377. The truth of the matter is, even if it's a little bit higher, it's not going to make a significant difference unless the number's like 500 or 600. If it's below 400,000, honestly, it's going to be just fine. No one's going to make a big deal out of it because the number has been consistently going lower and lower and lower. A little slower than I'd like to see, but it has been going lower, and even the moving average is now below 300 or 400,000. So again, anything below 400,000, 380, 350, 340 would be great, but I'll take it because the numbers have been really good. Again, keep your eye on the bond market. I told pretty much over the last month, anybody who's watching this show or these videos, that the bond market is set to decline because the economy looks like it's increasing, and that's the case right now. Now, with that said, it doesn't mean that the stock market is ready to rock and roll. If you look at the stock market, which made all-time highs, it's still extremely fragmented. The put-to-call ratio, the divergence between price and the RSI. I mean, look at this. We're making all-time high. The RSI can't even go to 66. That's one hell of an overbought market. And again, if you look at the mid caps, and this is what I keep bringing you guys up to, the markets are choppy. This is really what the market looks like. I mean, even more so, let me show you those small caps. This is really, really what the market's looking like. Choppiness, just a lot of choppiness. So when the market's choppy, you don't want to be a hero and be very directional for a long time. And it's fragmented. Look at technology, top place, and look at consumer discretionary. Consumer discretionary and technology should be next to each other because think about it, Amazon, Apple, all those stocks, they're mixed, but that's a fragmented market, and we need a good little pullback to bring everything back from a distorted, fragmented market where that rubber band is stretched out like this into a solid, staple market. Let's talk about global economy. You're not going to learn too much here. It's pretty much what we already know. At the top of the watch list is Federal Reserve's annual convention in Wyoming. I wish I was in Wyoming right now. The weather there is beautiful. It's like 97 degrees here. And the last 2 weeks of August is not a time to be in Florida. The Fed Chair, Mr. I Can Predict the Future Powell, is scheduled to speak on Friday. And we're going to see if he talks about, it's not what he says, it's the words that he uses. Although this guy likes to predict things way in advance. If he starts talking about, well, things are getting better faster than expected, things are moving better in anticipation, lower bonds. If he starts talking about how we're surprised the COVID is still, and we don't know what's going to happen, then probably the bond market will just stay stable. I can't really see a situation where the bond market goes much higher than it is right now. I think it'll either stay near where it is or go lower. Now, traders are betting that the Fed officials will remain in a wait-and-see mode since policymakers believe inflation earlier this year will be temporary. Have you guys gone to the supermarket lately? Have you checked beer prices, gas prices, cigarette prices? Temporary? I hope it's temporary because it sure as hell doesn't feel like temporary to me. And rising COVID cases has made some economists worried. I'm worried, and I'm not an economist. But I think things are going to get better. I think the worst is behind us with the Delta variant. I think a few more weeks and things are going to start declining because heat has a lot to do with it. Those COVIDs, they sure like heat. All those things they expand, they thrive in heat. In Asia, traders await more clarity on Chinese regulator reform and impact on tech stocks. Folks, you do not want to be in tech stocks right now. Chinese tech stocks. Do not. Fade them. Don't buy them. So again, as I mentioned, the market is rather fragmented because of the I keep saying put to call ratio because of sectors. This is tech is up here, consumer discretionary is up here, and I think we're going to see more upside on the energy sector over the near term. But that's just my opinion. In terms of the overall market, if you look at number of stocks breaking out, you've got 186 stocks making 90-day highs, 15 making 90-day lows. The market is still kind of subdued and is still very, very choppy, and I'm hoping today's news, the Fed data, the GDP and jobless claims can break us out of that. But again, keep your eye on the bond market. The bond market is in play right now. And the fact that we're going lower, the highs are getting lower, I think we're going to break through this 200-day moving average and interest rates are going to finally start going higher. Now on that, because the market's really choppy and because the market does not have a directional bias, as you will see again right here, I'm very nervous about the upside. I don't think we're going to really go much higher. I think we're going to stay choppy, and I think we're almost as high as we're going to go on this market in the short term. And instead of going long, I think the odds are better. Instead of you guys going long, the odds are better for you if you fade a couple of stocks. So today I have a couple of stocks that are doing crappy. Lower highs. Here's a big thing I look for. Lower highs and a breakdown below the 200-day moving average and then a pullback to the 200-day moving average. So as you can see right here, we've got lower highs, right? Lower highs. We have a breakdown of the 200-day moving average. That's the 200-day, this mustard colored line. And it's a second test and it finally broke down. And now it's back up to the 200-day line. And it looks like the trend is going to extend again. And so I'm bearish on this stock. This is TransDigm Group. Bearish, bearish, bearish. I think we're going to go lower. And if we break this area, the 586, there's a really good chance, because that's the neckline right there, that we'll go all the way to 522. So TransDigm Group is on my sell list. Again, two lower highs, a breakdown below the 200-day moving average, and then a pullback to the 200-day moving average. Next, this was a big, big stock. I loved this stock during last year's COVID pandemic, but since then, I guess pet insurance is not as hot as it used to be. People are moving back towards regular insurance. But yeah, folks are not spending as much money on pet care because they're not staying at home as much. So pets are not as hot as they were last year. Notice, two lower highs, right? Lower highs. We break down the 200-day moving average, and then we pull back to the 200-day moving average. And now I'm looking for another pullback to the downside. Very similarly to how I trade to the long side, except we're reversing everything. So again, two lower highs, a breakdown below the 200-day moving average, and then a pullback to the 200-day moving average in hopes of us breaking down again. And if this thing breaks the 84 level, there's a good chance we can go down to the 71 level. Actually, that's what I'm targeting right now. There's really no support here till the 70 level. And again, lower highs, lower highs. Let's see how this one looks on a long-term basis. Lower highs. And it's on a 50-day on a weekly basis. So if this thing breaks the 50-day line on a weekly, watch out. But on a daily, as you can see here, it's pulling back, broke the 200-day, pulling back to the 200-day. And the beautiful part is, if it comes up here to the twilight zone, The area between the 50-day and the 200-day, you just liquidate it because we want to make sure it stays below the 200-day. So TransDigm Group and Trupanion. Two stocks that I think are going to break down. Now, I've got something important for you, something that I really hope you do pay close attention to. Chuck Hughes, he's a former Air Force pilot turned 10 times trading champion, and he's $1 million investor. He's got a brand new discovery. It's called 𝗎𝗍, and it recently triggered a trade on SMH. Let me show you SMH. That's the semiconductor index, by the way, just so you know, one of my favorite indices, and it's doing really good right now. Yeah, this one's breaking higher. And this SMH signal spitted out a perfect 0.01 rating. And again, his system, his methodology does all of it for you. All you've got to do is just follow the trade. If you want to learn more about Chuck's 𝗎𝗍 service and how this 0.01 signaled a healthy 107% gain in this SMH, man, that's a nice little juicy gain. Be sure to click on the link below. And folks, you know what to do. Make sure to like this video. Subscribe to this channel if you're watching on YouTube. You've got to stay ahead of the market by being the first to be notified when I post a new video for you. How else are you going to learn about market momentum, fragmentation, divergence, the bond market, the Fed data, and two stocks that are breaking down? Follow these videos, and I'll talk to you guys later. And if you have questions, feedback, love letters, hate letters, anything, send me an email. support@marketgeeks.com. I want to know if you're getting any value out of these. And if you've made good money because of me, let me know as well. I'll share it with the rest of the guys. Bye. Have a great, great Thursday. It's Friday Eve. Let's make it a Friday Eve since it's Thursday. Bye, everyone.